Hey, Tim Rosen here, guiding you towards financial peace of mind. Today I pose the question, what role do investment magazines have in your financial portfolio? My answer, very little. Magazines could be entertaining, and they're cheap, about $3.99, and I would caution against looking to a magazine for financial advice. I mean, do we think that for $3.99 we can capture the wisdom of Wall Street? As with any other magazines, there's the good, the bad, and the ugly. So I'm looking at Kiplinger's magazine here for the month of December. And there's good, and there's bad, and there's ugly. Normally magazines are good enough to put the words advertisement at the top of a page when something looks like an article and it really catches your attention, but they're really promoting a product. And that's fine, and these are some of the things you want to look out for. Is this advice or is this an advertisement? Advertisements are designed to sell you something. Think of the words of Steve Forbes. He's quoted, it was April 15th, 2003. Steve Forbes says, there's more money to be made selling the advice than following the advice, and he applies that philosophy to the magazine industry. And it makes sense. There's more money to be made selling magazines and selling the advertisements in the magazines than there is following the magazine's advice. And I think we ought to heed those words. There's an article that caught my attention in this month's magazine. We have two writers writing a column on value investing, and I thought, well, I'd read it, check it out, see what they have to say. And they start by telling the story of John Templeton, how he purchased $100 worth of every U.S. stock just at the onset of World War II. And of course, 4 years later, he made a bunch of money. And value investing is buying stocks that have fallen out of favor, the price is down, speculating that you'll make more money later. Well, then they go on and say, they kind of make some recommendations here. They say, well, there's two companies that fit this category of value stocks. They mention Pfizer and they mention Yahoo. Now, what do you think readers of this article would either want to do or actually go out and do? Buy Yahoo? Buy Pfizer? Some would be imprudent enough to borrow money just so that they can buy these stocks. Or worse yet, sell what they already have just to buy one of these quote-unquote recommendations. Now, this article, which is a column, does not say advertisement, so you could look at that and say, well, these guys know what they're doing, so they're making recommendations. Well, they're not hiding the fact that down at the bottom, there is a little disclaimer, and it says, by the way, one of the writers of this article he manages a mutual fund that has Yahoo and Pfizer. So what does that tell you? Maybe a little conflict of interest. Maybe there's a financial interest in him promoting Yahoo and Pfizer so that if the masses see this and then there's all of this purchasing going on of Pfizer and Yahoo, massive buying increases the price. Makes him look good as a fund manager. Those are two holdings in his mutual fund and the values go up and he looks good. So you kind of have to clear the smoke when you're looking at and reading magazine articles and say, well, what's their angle? What is their incentive for promoting this or for promoting that? You can learn, but I caution against taking the advice of magazines, because let's say that you do fall for it and you buy this stock. Well, guess what? Next month there's another magazine and there's going to be another article recommending this or recommending that, and that is designed, the articles in magazines are designed to tempt your obsessive speculation tendencies. You're looking for the next silver bullet. You're looking for the next best investment advice. If you follow it, it often causes you to lose money and underperform. Here's some numbers to look at right here from the Dalbar study. I'm going to get in right here. If you take a look at that, from 1984 to 2005, the S&P gave an average return of 11%, but the average investor, only 4%. Part of the problem, look down there at the bottom, the average holding period for that mutual fund or stock is 2.9 years. Does that sound prudent? Absolutely not. If you're going to be in the stock market, we need to have a long-term approach. I recommend that we be properly diversified across all asset classes, depending on your risk tolerance. But your exposure to the S&P is limited. You've got global markets, emerging markets, bonds. And this takes time, talking with and consulting with a registered investment advisor, someone that you trust, someone who's not going to be selling you these stocks, bonds, and mutual funds. So when it comes to magazines, know that it's entertainment. Know that they make more money selling the magazines than the advertising. Know that you're not going to capture the wisdom of Wall Street. And it's very imprudent to follow the advice from magazines. There you go. And Kiplinger Magazine, certainly a good, reputable name, but it's definitely not a process to follow when it comes to planning your financial future and building your portfolio. You don't want to take the advice of magazines month after month and changing and getting in and getting out of funds, causing you to lose money. Can't have peace of mind that way. Thanks for tuning in. Tune in next week. Tim Rosen, timrosen.tv.